I am Dr. Sonam Badoria, Assistant Professor at Swami Rama Himalayan University. In today's lecture, we are going to explore the life cycle of securities from their birth to their trading in financial markets. Our topic is securities issuance and trading mechanism. Securities such as equity shares, debentures, bonds and derivatives are the fundamental building blocks of financial markets. But how do they enter in the market, and once issued, how are they actually traded? Understanding these mechanisms is essential for students of finance, investors and professionals who are involving in capital raising or market operation. So let's begin with securities issuance mechanism, to process by which the companies bring new securities to the market and raise capital. There are two major types of issuance process. First is primary market issuance and second is secondary market trading. Here, the primary market issuance is where new securities are created and sold for the first time. The capital raised goes directly to the issuer, typically a company or government. There are several methods through which securities can be issued in the primary market. First is public issue. This is the most well-known method. A company invites the public to subscribe its securities through an initial public offering and follow on public offerings. The company must file a prospectus with SEBI, disclose its financials and undergo rigorous compliance. Second is the private placement. Here the securities are issued to a select group of institutions or high net worth investors rather than the public. It is faster, less costly and involves fewer regulatory requirements. Third is the right issue. This method allows existing shareholders to purchase additional shares at a discounted price in proportion to their current holdings. It helps companies raise funds without diluting control too quickly. Next is preferential allotment. In this case, shares are issued to a specified group of investors, including promoters, strategic investors or financial institutions, often a negotiated price. SEBI regulations mandate fair pricing and disclosure. Next is qualified institutional placement. This is a fast track method for listed companies to raise capital from qualified institutional buyers without undergoing elaborate procedural formalities. Let's now shift to the secondary market, where previously issued securities are actually traded among the investors. The secondary market includes stock exchanges like NSE, BSE, where investors buy and sell securities among themselves. Here, the issuing company does not receive any money. The transaction is purely between investors. The two main type of markets under the secondary segment are: first is the equity market and second is the debt market. In equity market is the market where shares and equity derivatives are traded, and debt market is where bonds, debentures and debt instruments are traded. Now, let's understand the trading mechanism, what is the process involved here. Trading in India financial market today is highly automated, regulated and efficient. Let's walk through the major mechanism. So first is the electronic trading. Almost all trading today happens on electronic platforms like NSE's NEET system and BSE's BOLT system. These platforms match buy and sell orders based on price and time priority. Order types. Investors can place various types of orders: market orders, limit orders, stop loss orders, good till cancelled order and so on. These give traders control over pricing and execution strategy. Then if we talk about the settlement mechanism, now trades in India follow the T1 settlement cycle, which means the transaction is settled one business day after the date of trade. SEBI reduced the cycle from T+2 to T+1 to improve liquidity and reduce the risk of the investor. Next is the clearing and settlement. After a trade is executed, clearing corporation like NSCCL and ICC step into the managed counterparty risk and ensure successful settlement. Funds and securities are exchanged through designating clearing members and custodian. Next is the dematerialized trading. Securities are held in the electronic form through depositories like NSDL and CDSL. Investors trade through their demat and trading account, removing the need for physical certificates. Next is circuit breakers and surveillance. To prevent extreme volatility, stock exchanges implement circuit filters and trading halts. Additionally, SEBI and exchange use algorithm for real-time surveillance to detect manipulative trading practices. Next is what is the role of market intermediaries here? The issuing and trading require the support of several intermediaries. What are they? First is the merchant bankers. A merchant banker helps companies structure and manage public issues. Next is stockbrokers. They facilitate buying and selling on behalf of clients. Next is depositories or depository participants. They maintain dematerialized holdings and handle settlements also. Next is clearing corporations. It ensures finality and security of transactions. Then the registrars and the transfer agents, they maintain records and investor services. Together, all these players form the institutional framework of the security market. Now, the next concept is what is the regulatory framework behind it. In India, the Securities and Exchange Board of India, SEBI, is the chief regulator. It governs basically the issuance norm under ICDR regulation. It look for the listing requirement. It also look after the insider trading prevention. It also works upon continuously on the investor protection. It also look after the broker conduct and surveillance. Stock exchanges like NSE and BSE are regulated entities and operating under SEBI guidelines. If we talk about what are the innovations in issuance and trading, the Indian securities market has been some significant innovations in last recent years. First is the book building process. Here, the price discovery for IPOs through demand-based bidding. Next is anchor investors. In IPOs, large institutions can algorithm before the public to build confidence. Next is the algorithm trading, which means the automated high-frequency strategies gaining momentum. Next is direct market access. Institutional investors can place orders directly into the exchange without manual broker intervention. Mobile trading platforms increasing retail participation through apps like Zerodha, Grow and Upstock. If we talk about the investor protection, SEBI has introduced a range of measures to protect investors' interest, like there is the mandatory disclosures and risk factors in public offerings. The investor education programs through scores and SEBI investor web portal. It includes the compensation funds to address investor grievances. Now, there is a ban on unfair trade practices like front running, circular trading and insider trading. So, let's recap what we have covered today. First is the primary market allows companies to raise capital via public offering, right issues and private placements. Here we learned today about the secondary market also. It provides liquidity and market driven valuation through stock exchanges. We learned about the trading mechanism, which is basically the electronic, transparent, and it is governed by a strong settlement infrastructure. We also learned about various types of intermediaries, basically the multiple intermediaries, and regulatory standards ensure the integrity of the system. Understanding how security markets are issued and trading in a key participation confidently in financial market, whether you are an investor, an analyst, or a policy maker. As we conclude, consider the few questions like how do different issuance routes affect investor confidence? Think what role do brokers and clearing houses play in reducing the systematic risk? Can it be controlled or not? How can retail investors leverage technology to trade more effectively? Thank you for joining me in this session on securities issuance and trading mechanism. In our next lecture, we will discuss recent developments in Indian financial markets, including digital innovations, regulatory reforms, and the latest market trends. Until then, stay updated, stay informed, and keep strong. Thank you. Namaste.